Market structure is the sequence of price movements expressed through highs and lows, which allows you to determine the current direction of the market and its underlying logic. Simply put, market structure is the skeleton of the chart that shows where the market is moving and who is in control, buyers or sellers. A downtrend structure is formed as a sequence of lower highs and lower lows. An uptrend structure is formed as a sequence of higher highs and higher lows. However, in reality, charts rarely look this clean. When you try to map structure on a live market, it usually looks much more complex and less organized. To make the chart clear and analyzable, it is important to distinguish between external and internal structure. External structure forms the sequence of higher highs and higher lows, or lower highs and lower lows, which we use to analyze the trend. Internal structure refers to the movements within the external structure, essentially moves that happen inside the trend. To mark the external structure on the chart, first identify a clearly defined swing. Essentially, this is a swing that is clearly pronounced, an aggressive move on the chart. Pause the video and find the aggressive move in this part of the chart. It will be this move here. Now find it in this part of the chart. Most likely you will mark either this move or this one. However, if the move you found engulfs the previous move, then the previous move is the one you were actually looking for. And let's take one more example. It will be this move here. The upper and lower boundaries of that swing define the range of the external structure. Everything inside these boundaries is internal structure, which means it is a correction. Everything that breaks beyond these boundaries is external structure, which means it is a new impulse wave. When price moves beyond one of the boundaries, it updates the external structure. If we want to map the external structure step by step, we shift our reference zone to the move that created the new structure. Then we extend this zone and observe where price breaks its boundary. If price is in a downtrend and the break happens in the direction of continuation, meaning price breaks the lower boundary, this is called a BOS, or break of structure. In simple terms, BOS is a move that confirms the continuation of the trend. In a downtrend, it is the break of a key low. In an uptrend, it is the break of a key high. At this stage, we can already start drawing the external structure more clearly. Next, we repeat the same process. We shift the zone from the correction high to the point where price breaks the previous structure low. As we continue applying this technique, the structure gradually becomes cleaner and starts to resemble the classic textbook example of trend movement. From here, we simply continue applying the same logic until the entire structure is fully mapped. In market structure analysis, there are two key concepts: break of structure, known as BOS, and market structure shift, known as MSS. BOS is a break of structure in the direction of the trend, which confirms continuation. MSS, on the other hand, is a structural break that signals a potential trend reversal. In an uptrend, MSS happens when price breaks the last higher low to the downside. In a downtrend, MSS happens when price breaks the last lower high to the upside. This is the moment when the market begins to show signs that the current trend may be ending. Try applying this method on your charts. After just a few attempts, you will start to see how logical and how simple market structure really is. You already know how to identify structure, how to identify BOS, and how to identify miss. However, if you use these tools blindly, your win rate will most likely not exceed 20%. Now it's important to understand the next step: how to distinguish fake MSS formations and how to determine when the market is truly ready to continue an uptrend or a downtrend structure. After price forms such a formation, there are three possible scenarios. The first scenario is when price creates a fake mass and continues moving in the direction of the current trend. The second scenario is when price enters consolidation and starts moving within a sideways range. And the third scenario is when the market confirms a reversal and we see a full trend change. But the key point here is that MSS itself is not an entry signal. It is not an execution point, it is an analysis point. And at the moment an MSS appears, you need to ask yourself several important questions. The first question is, has price reached the potential point B? It is very important to understand where price is within the current move. Point A is the start of the trend. Point B is the logical target zone of the move, for example, a liquidity area or a key higher time frame level. If price has not reached point B and is still in the middle of the range, this often indicates that the MSS may be fake. Real reversals most often occur not in the middle of a move, but after reaching target zones, after liquidity has been taken, and at logical structural completion points. The second question is, which asset are you trading? It is important to consider the nature of the instrument. Some assets tend to change direction frequently, while others spend most of their time in strong, sustained trends. For example, currency pairs like Euro to US dollar or US dollar to Japanese yen often show more more frequent structural shifts, while indices such as the S&P 500 or the NASDAQ 100 more often develop strong directional trends. Understanding this helps you interpret MSS correctly, whether it is a real reversal or just a correction within the trend. The third question is, what is happening on the higher time frame? This is one of the most important factors. If the higher time frame is in a strong uptrend and on the lower time frame an MSS to the downside appears, the probability of a global reversal is usually low. In most cases, this will be either a local correction or a liquidity sweep. This is why multi-time frame alignment is critical. The fourth question is, are there any fundamental or macroeconomic factors? The market does not always move purely based on technical structure. Price movements can be influenced by macroeconomic changes, geopolitical events, key economic news, central bank decisions, or internal changes within a specific asset. If an MSS aligns with such an event, the probability of a real reversal increases significantly. Now, the key element that helps distinguish a fake MSS from a real one is confirmation. The more confirmations you see, the lower your chance of falling into a market trap. The first confirmation is the aggressiveness of the move. After an MSS, it is important to observe how price behaves next. If price aggressively holds above or below the MSS level and forms strong impulsive movements, this may indicate institutional participation. An additional confirmation is the presence of imbalance within or just after the MSS zone. On the other hand, if after an MSS price moves weakly, without momentum and without strength, this is often a sign that the structure will turn out to be fake. The second confirmation is a return into the range. If after an MSS price returns inside the previous swing range and starts trading within it, this often indicates a transition into consolidation rather than a new trend. Such situations frequently lead to sideways movement. It is especially important to pay attention to deviations when two MSS formations appear, after which price returns back into the range. This is an early sign of consolidation. The third confirmation is invalidation of holding zones. In every trend, there are zones that hold price. These can be support and resistance levels, order blocks, imbalance zones, or other key areas. If price breaks and holds beyond these zones, it is a strong signal that the structure is starting to change. The fourth confirmation is the formation of new zones in the opposite direction. After an MSS in a new direction, new structural elements begin to appear. These can include new order blocks, new imbalance zones, or new support and resistance areas. Each of these elements increases the probability that the market is truly changing direction. In conclusion, it is recommended to use at least 3 confirmations before making a decision. This significantly increases the accuracy of your analysis, helps avoid false entries, and improves your win rate in the long term.